Chapter 3: The Accounting Information System. The learning objectives: 1. Analyze the effect of transactions on the accounting equation. 2. Explain how accounts, debits and credits are used to record transactions. 3. Journalize transactions in the general journal. 4. Post transactions to the general ledger. And 5. Prepare a trial balance. Accounting transactions. The accounting information system is used to collect and process transaction data and communicate financial information to decision makers. Factors that shape these systems include the type of business and its transactions, the size of the company, the amount of data, and the information that management and others need. Accounting information system rely on a process referred to as the accounting cycle, which is a series of steps used to account for and report transactions. In this chapter, we will be discussing the first 4 steps of the accounting cycle. The first step in the accounting cycle is to analyze transactions. However, not all transactions that affect the company are recorded and reported. For example, suppose a new employee is hired. Should this transaction be recorded in the company's accounting records? No. An accounting transaction will not occur in this particular situation until the new employee has started work and earned his or her salary. So, in general, an accounting transaction occurs when an economic event results in a company's financial position, such as assets, liabilities, or shareholders' equity, changing in a measurable way. In the case of the new employee, no assets, liability, or equity is affected by the act of hiring the employee, even if the employee signs an employment contract. Not every economic transaction will have an impact. So let us have a look at some examples of economic transactions. 1. Purchase a computer. We have to first analyze, does this affect assets, liabilities, or shareholders' equity? Those are the 3 accounts. In this case, it does affect our assets, so yes. Then we record it. The asset account increases in equipment, which is our computer, and decreases in cash because we pay cash out for the computer. Our second example, discuss product design with a potential customer. Does this affect assets, liabilities, or shareholders' equity? In this case, there is no economic transaction, so it has no effect on the company's current financial position, so we do not record anything. Third, pay rent. Does it affect liabilities? Does it affect assets, liabilities, or shareholders' equity? Yes, it does. Which ones? Cash goes down, which is an asset. The other side is shareholders' equity. Do you remember what makes up shareholders' equity? That is common shares and retained earnings. So retained earnings is made up of revenues, expenses, and dividends declared. So the rent expense account is increased. Steps in the recording process. There are 4 steps in the recording process. Step 1. Analyze each transaction to determine its effects on accounts. Step 2. Record transaction as a journal entry in the general journal. Note that a general journal is nothing more than a book of general journal entries. Step 3. Transfer journal entries recorded to appropriate accounts in the general ledger. And step 4. Prepare a trial balance. Transaction analysis determines impact on the accounting equation. So here we have the basic accounting equation, which is assets equal liabilities plus shareholders' equity. Note that the accounting equation must always balance. Therefore, each transaction has a dual or double-sided effect on the equation. This is the expanded accounting equation. Assets equal liabilities plus shareholders' equity. Shareholders' equity is composed of common shares plus retained earnings. Further, within retained earnings is equal to net income less any dividends declared. Net income, which is equal to revenues minus expenses, increases retained earnings. Dividends, when declared, are a distribution of retained earnings to shareholders and result in a decrease to retained earnings as well. The account. An account consists of three parts. One, the title of the account. Second, a left or a debit side. And third, a right or a credit side. Debit simply means left, and credit simply means right. Because the alignment of the three parts of an account resembles the letter T, it is referred to as a T account. A T account is also known as a general ledger account. This is further examples of debits and credits. So it describes where entries are made in the accounts. So debiting is entering an amount on the left side, while crediting is entering amount on the right side. If the debit amount exceeds credit amounts, then the account has a debit balance. And if the credit amount exceeds debit, the account has a credit balance. Normal balances. Accounts have normal debit or credit balances, depending on whether they are asset, liability, or shareholders' equity accounts. The normal balance of an account is always the side that is used to increase the account. Assets are on the left side of the accounting equation and T account. Increase in asset accounts are entered on the left or debit side of a T account, while decreases in assets are entered on the right or credit side. For the liabilities, liabilities are on the right side of the accounting equation. So liability accounts normally have a credit or right side balances. Increases in liability accounts are entered on the right or credit side of a T account, while decreases in liability accounts are entered on the left or debit side. All asset accounts are increased by debits and decreased by credits. All liability accounts are increased by credits and decreased by debits. However, shareholders' equity consists of different components, and they do not all move in the same direction. Shareholders' equity is usually composed of common shares and retained earnings. Retained earnings can be further subdivided into revenues and expenses, which together makes up net income and dividends declared. For increases in shareholders' equity, common shares and retained earnings both increase shareholders' equity. Consequently, the common shares within retained earnings and revenue accounts are increased by credits and decreased by debits. The normal balance in these accounts is a credit balance. For decreases in shareholders' equity, expenses and dividends declared both decrease retained earnings. Expenses combined with revenues to determine net income. Thus, expense accounts are increased by debits and decreased by credits. Because expenses and dividends declared accounts are increased by debits, The normal balance in these accounts is a debit balance. This expanded accounting equation shows the normal balance of each of the T accounts and the debit and credit effects. The asset normal balance is debit and it is increased by debits. Liabilities normal balance is credit and it is increased by credits. Shareholders' equity, which includes common shares, retained earnings, and revenues, the normal balance are credit and they are all increased by credits. Expenses and dividends declared normal balance is debit and they are increased by debits. General Journal, Step 2 of the accounting cycle. Accounting record where the transactions are recorded in chronological order. Chronological order basically means according to when it happens. So first, second, third, fourth as an example. General Journal is more common. Other journals can include, examples are cash receipts, cash disbursements, which means to pay out, sales, purchases. Entering transaction data is known as journalizing. Most companies list their general ledger accounts in what is called a chart of accounts. The chart of accounts is a framework for the accounting information system. It lists the accounts and the account numbers that identify where the accounts are in the ledger. Similar to the ledger, the chart of accounts usually starts with a statement of financial position accounts followed by the income statement accounts. Posting. Now, posting involves transferring information from the general journal to the general ledger. For example, the date and amount shown on the first line of a general journal entry is entered in the debit column of the appropriate account in the general ledger. The same is done for the credit side of the entry. The date and the amount are entered in the credit column of the general ledger account. The fourth step in the accounting cycle is to prepare a trial balance. A trial balance is a list of general ledger accounts and their balances at a specific time. It is prepared at the end of an accounting, which is usually monthly, but could also be quarterly or annually. The main purpose of a trial balance is to prove or check that the debits equal credits after posting. That is, the sum of a debit account balance must equal the sum of the credit account balances. This is an example of the trial balance of Sierra Corporation as at October 31st, 2018. We can see here that the debits is equal to the credits. Debits 37,700 and credit 37,700.